Hello, I'm Paul Cooper, Corporate Reporting Manager at ACCA. I'm here with Richard Martin, Head of Corporate Reporting at ACCA, to discuss the new accounting directive which emanates from the EU. So Richard, we've discussed the IFRS for SMEs, but there are changes which will affect all companies in Europe, not just those adopting the IFRS for SMEs. Can you outline what's going on here, please?
Yes, that's right. In 2013, so a few months ago, the European Union finalised its accounting directive, and what that means is that then in every one of the member states, the company legislation for accounting will have to be changed. So that's change. When change happens, sometimes governments decide to add various things in. But the important thing is that there are quite a lot of member state options, in other words, choices that those 28 governments have to make about how to implement the accounting directive in their particular country. Incidentally, as we were talking about the IFRS for SMEs, a few of the changes do actually help with the adoption of IFRS for SMEs if countries wanted to do that. The changes are helpful on the whole.
Great. Which size of a company is most likely to be affected by the directive?
Yeah, it's going to be, I'd pick out two in particular, Paul. I would say firstly there are the oil and gas, mining and forestry companies. And they will have to do a completely new and separate report that they've not done before, and that is about payments that they make to governments around the world. It's called the country-by-country reporting, and it is literally that. So it's how much they're paying to the government in a particular country, and that means taxation. It means the royalties they're paying for access to the mineral or forestry rights, and indeed other sorts of payments that might be even less transparent than those. But there are, of course, very few of those companies, so relatively few will be affected, and they tend to be large. The other group are small companies, and clearly here we're dealing with a very large number of companies. In fact, the huge majority of companies in Europe are small, and they are significantly affected by these these changes. Firstly, in terms of just thresholds. So there is a new category of company called the micro company, which will be created. That's for companies who have a turnover of less than 700,000 euros a year, for example, and less than 10 employees. And so that's a new category. That will, again, I suspect, be the majority of companies in Europe will qualify as micro companies. But the small category, including micros, is also extended, because the thresholds there have been raised to up to 12 million euros of turnover, and 50 employees, for example. So these are the groups of companies most affected. There will be more companies in those categories.
Right. As micro entities seem to be the largest category, can you just run through what the accounts will look like for micro entities should they take maximum advantage of the exemptions in the directive?
Yeah, for micro companies, I think the theme is reductions in requirements. So if we were to look at what a balance sheet might look like for a micro company in the future, which is on the slide here, what we're looking at there is perhaps just a handful, literally, of items on the balance sheet, and with no further analysis. So just current assets, we won't be able to tell, for example, how much is stock. How much of those current assets are cash. Same with the P&L, a much shorter profit and loss account, again being illustrated on the slide that you can see. So much briefer there. Notes to the accounts, virtually non-existent. There will just be literally a few, which are literally one or two, which are principally about contingencies and commitments, and that's it. There are then some restrictions and changes on the accounting, so no revaluations allowed, and member states may opt to include this rather strange category of reduced accruals for certain overhead expenses.
So there's going to be big changes then for micro entities. Yeah. Will there be similarly large changes for small non-micro entities, again if they take advantage of the exemptions available?
Exactly. So we're talking about in the plus 700,000 of income up to the 10 million, up to the 12 million, category. Here again, the story overall is about reductions in requirements, but less change here because the existing formats will continue to be required, and there will be considerable and the accounting the accounting treatments that are required by the directive will be there as well. There will be, however, disclosure reductions in terms of the notes to the accounts, and we can see on the slide here the notes that are going to be required. And what's important to understand about this list is that that is all that can be required. So we're talking about maximum harmonisation here. This is laid down by the European Union. Member states cannot add to what they've what's on this list, except that there is a further list of ones that member states can choose to add, and these are 5, again being shown on your screen now. And what I think is very significant to note here is that these 5 include some very important disclosure requirements, and I'd highlight just, for example, related party transactions and post-balance sheet events. Now, I think it's reasonable to ask whether you can have a set of accounts that gives a true and fair view without having related party disclosures, or indeed the post-balance sheet events.
So what has ACCA's view generally been on the proposed changes in the directive?
Yeah, I think well, we see these reductions in requirements for the small and micro companies. Those might seem to be quite helpful, but I think that actually they do raise issues. I don't believe being asked to disclose these sorts of items that come directly out of people's accounting systems and software is very onerous, so that I don't believe the reductions in what you've got to show really represent any significant reduction in cost. And I think you also have to bear in mind that some of these items will be required by the tax authorities anyway. So it's a matter of not having. You'll still have to prepare some of these items, even though you may not be disclosing them on the public record. And it's the public record that is really the big change here. What we can see is it's not clear that there are big cost advantages to the enterprises. What is very clear is that there will be reductions in the financial information that is available to users of accounts, creditors, other trading partners and so on, and that I don't know whether we're not so sure that's a very good thing. And I've highlighted also the significant member state options that we believe member states actually should exercise and retain those items, and we'll be of course pressing for member states to do that.
Great, thank you, Richard. And it does seem that there's plenty to watch out for if you're a preparing company in an EU member state. Thank you also for watching this podcast, which I hope you found very useful.